Welcome to the Deep Dive, where we plunge into the most crucial topics to get you truly well-informed. And today, we're tackling something pretty significant, actually. Something with a huge, often unseen impact on our planet.
Mm.
I mean, here's a statistic that might just stop you in your tracks. Real estate. It actually contributes approximately 40% of global greenhouse gas emissions.
40%. That's massive.
It really is. That's according to the United Nations Environment Program Finance Initiative.
Okay.
So the big question we're asking today is, how deeply are financial institutions actually implicated in this enormous carbon footprint?
Well, yeah, that's a critical question, and it brings us right to the concept of financed emissions.
Financed emissions.
Yeah. So these aren't the emissions from, a bank's own offices or their company cars.
Yeah.
Not the direct stuff.
Right.
Instead, they're the indirect greenhouse gas emissions that financial institutions are responsible for through their lending, their investing, their underwriting activities.
So it's the impact of the money itself.
Exactly. Think of it like the carbon footprint embedded within their entire balance sheet. It's huge.
Okay, let's unpack this then. Our mission today is to really get our heads around why accounting for these financed emissions is so crucial. For financial institutions, sure, but also for real estate portfolio owners.
Absolutely. And it's not just about being green either.
No, it sounds much more fundamental. It's like banks are finally having to see this invisible climate risk that's, well, embedded directly in their loan books.
Precisely. It's not abstract anymore. It's about protecting their own financial future.
Okay. And then later on, we're going to explore how some innovative solutions, particularly data-driven approaches like this called Lookthrough, are stepping up to tackle these really complex challenges.
Yeah, the solution side is key.
Definitely. So when we talk about emissions, it's not all just one big blob, is it? There are these different categories, these scopes.
That's right. The main international standard, the GHG Protocol, it breaks them down to 3 scopes. Helps clarify things. Scope 1 is pretty straightforward. It's the direct emissions from resources a company owns or controls.
Like if a company has its own fleet of delivery vans.
Yeah.
The exhaust fumes.
Exactly that. The tailpipe emissions from those vans, that's Scope 1. Simple enough.
Okay. And Scope 2?
Scope 2 covers the indirect emissions from purchased energy. So think of the electricity a company buys to, power its office building or run its factories.
Right, the electricity bill, essentially. The emissions generated to create that power.
You got it. Now, where it gets really interesting and central to our discussion today is Scope 3.
Okay, this is the big one.
Well, it's certainly the broadest. Scope 3 covers all the other indirect emissions, stuff that happens because of a company's activities, but from sources they don't directly own or control.
So it's kind of everything else in the value chain.
Pretty much. And crucially, this is where financed emissions live. They fall squarely into Scope 3, specifically Category 15, investments.
Category 15, okay.
So yeah, we're talking primarily about the emissions stemming from lending and investment activities.
So if I'm getting this right, Scope 3 is incredibly broad. It must cover a huge range of things, way outside a company's direct operational control. For a financial institution, like a bank, this surely isn't just a small footnote then.
Oh, absolutely not. It's the main event for them, climate-wise. For a typical bank, the emissions from their own branches, their data centers, maybe corporate jets, that's often tiny compared to the emissions of the companies and projects they finance.
Really? That much difference?
Yeah, consider the scale. Take a major bank like Fifth Third Bank, for example. They reported their indirect finance emissions are more than 70 times larger than their combined Scope 1, Scope 2, and all their other non-financing Scope 3 emissions put together.
70 times, wow.
Right. That massive difference really underscores why financed emissions are such a critical piece of the puzzle in any financial institution's climate strategy. It's not really about their light bulbs. It's about their loans, their investments, where the money flows.
Okay, this really changes the perspective, doesn't it? It fundamentally shifts how a bank should view its own green initiatives. It's not just about, recycling bins in the break room or turning off lights.
It's not at all. It's a much bigger picture of risk and opportunity tied directly to their core business.
So what's fascinating here, then, is that quantifying these emissions, it's not just about ticking a box or getting a number, is it?
No, it goes way beyond just tallying numbers on a balance sheet. It dramatically increases transparency. It gives institutions a much deeper understanding of their exposure to climate-related risks. Physical risks, transition risks.
Right. Like, is that coastal property they finance going to be underwater? Is that fossil fuel company they lent to going to face stricter regulations?
Exactly. And that understanding, it can fundamentally alter future financing decisions. It starts guiding capital towards more sustainable activities, away from the high-risk stuff.
So the key insight here is banks finally seeing that invisible climate risk baked right into their loan books. It becomes visible.
It becomes visible, quantifiable, manageable, hopefully. And look, this is a foundational step if we want to align the financial sector with global sustainable development goals. It's about making sure the flow of capital in our economy is actively building a cleaner, more resilient future, not inadvertently, funding climate problems.
Okay, so this really explains why there's this pressure cooker building for financial institutions. They can't really ignore this anymore. What are the main forces really driving them to act now? Is it just the regulators?
Regulation is definitely a huge factor. I mean, we're seeing this global regulatory tide shifting. It's moving away from just voluntary guidelines towards mandatory harmonized reporting standards.
Like the TCFD. I've heard about them.
Yeah, the Task Force on Climate-Related Financial Disclosures, TCFD, set up back in 2015. They made recommendations, and importantly, they considered financed emissions disclosure as best practice, even then.
Okay, so that set the stage.
It did. And building on that, you've got the International Sustainability Standards Board, the ISSB. They were created in 2021 by the IFRS Foundation, which sets global accounting standards.
Right.
The ISSB is developing new standards, IFRS S1 and S2, and these are going to require disclosure of Scope 1, 2, and 3 emissions, including financed emissions. These are expected to become the international benchmark.
And we're already seeing countries actually putting this into law, aren't we? It's not just recommendations anymore.
Absolutely. Look at New Zealand. Their 2021 Financial Sector Act already mandates climate-related disclosures, including material Scope 3 emissions, for large financial institutions. That started in 2023.
Oh, so they're ahead of the curve.
One of the first, globally, yeah. The UK also announced TCFD-aligned requirements. The US SEC proposed similar rules back in March 2022, so it's definitely not just a European thing. It's becoming a global imperative.
Speaking of Europe, though, what about things like the EU's SFDR and the EU taxonomy? They seem to demand a whole other level of detail, especially for asset managers.
They really do. The EU's SFDR, that's the Sustainability-Related Disclosure in the Financial Services Sector Regulation, it lays down direct, mandatory reporting obligations for financial product providers.
And it has those categories, right? Article 6, 8, 9?
Exactly. It categorizes products based on their ESG alignment. Article 8 for products promoting environmental or social characteristics. Article 9 for those with sustainable investment as their objective. This is really pushing market behavior towards more sustainable offerings because investors can see clearly what's what.
I see.
And then the EU taxonomy, that takes it another step further. It actually defines what activities qualify as environmentally sustainable for specific economic sectors, including real estate.
So it gets really specific.
Very specific. It requires actual asset-level data for certain things. They're not just looking at a company's overall ESG rating anymore. They're asking, is this specific building energy efficient according to our criteria? What's its actual energy consumption per square meter? It's moving from these broad statements to granular, verifiable proof points.
Okay, so the regulators are pushing hard. But what about investors? Beyond the rule books, are they really driving this change? Or is it still kind of a niche concern for some? Are they genuinely putting their money where their values are?
That's a really important question. And yes, they are a critical driver. I mean, sure, moral concerns play a role for many investors.
Right.
But increasingly, they're also driven by, frankly, the pursuit of improved longer-term returns and protecting and enhancing their brand image.
So it's financial performance too.
Absolutely. Transparency and ESG performance, or lack thereof, directly impacts an organization's ability to raise capital and, importantly, the price at which it can do so.
Ah, the cost of capital.
Exactly. Companies without adequate ESG reporting, or those perceived as high risk from a climate perspective, they might find their valuations discounted by the market. We're already seeing the market attaching risk premiums to investments that fail to address these ESG challenges.
So inaction has a direct financial cost.
It does, and that creates a very powerful incentive for companies to take a proactive approach, not just wait for the rules to force them.
And this pressure, it isn't just hitting the huge global banks or massive asset managers, is it? You mentioned this trickle-down effect.
Yeah, absolutely. That's going to impact smaller organizations, too. Can you maybe give us a sense of what that looks like?
Definitely. Think of it like a pyramid, maybe.
Yeah.
You've got the big global investors, pension funds, insurers at the top. They need to report on their entire footprint, right?
Mm-hmm.
So they lean on the asset managers they allocate capital to. They need the data from them.
Okay.
Those asset managers, in turn, they need detailed data from the private equity firms or the property funds they invest in,
Right.
right down the chain.
Exactly. So this means even smaller organizations, maybe a boutique private equity firm or a regional property fund, they're going to face indirect reporting obligations because their larger funders, their LPs, require granular ESG performance data on their investments to meet their own disclosure requirements.
So it doesn't matter if you're directly regulated or not initially. If your funders are, you're going to need this data.
Pretty much. So yeah, regardless of your size, ESG reporting, especially around financed emissions for relevant players, it's really not an if anymore. It's definitely a when.
Okay, so the why is abundantly clear. The pressure's on from all sides. But let's get down to the how. Measuring these financed emissions. What's the biggest hurdle financial institutions are facing right now? It sounds like it can't be easy.
No, it's definitely not easy. And honestly, it all comes back to data. Data, data, data.
The classic problem.
It really is. Despite the clear need, accounting for financed emissions is, well, it's still in its infancy in many ways. A major, major hurdle is just the basic availability and quality of the necessary data.
So just getting the numbers in the first place?
Yeah. High-quality emissions data directly from the borrowers, the companies, or projects financed, it's often just unavailable, especially when you're talking about, say, individual households with mortgages or small and medium-sized businesses. Getting granular energy use or emissions data from them is incredibly difficult.
I can imagine. And beyond just the scarcity, the lack of data, it seems like there's also a real mess of different standards and definitions out there, right?
Oh, absolutely. That's what's fascinating and frustrating here, the sheer heterogeneity. There isn't currently a single universally accepted global ESG standard,
Mhm.
and you have conflicting definitions, different reporting requirements across different jurisdictions. It just creates a lot of uncertainty and inconsistency. How do you compare portfolios across regions if they're measured differently?
Yeah, that makes meaningful comparison almost impossible.
Exactly. And while methodologies do exist, like PCAF, which we'll talk about, offers options, some approaches, particularly the ones used when direct data is missing, have to rely on broad estimates.
Like using industry averages.
Yeah, things like sector-level data or average emission factors for a certain type of activity, globally or regionally. These often result in pretty low data quality scores, frankly.
So they give you a number, but maybe not a very accurate or useful one.
Right. They limit the usefulness for making really granular business decisions or for tracking actual progress in reducing emissions within a portfolio. It's hard to manage what you can't measure accurately.
Okay, so the data itself is a huge challenge. But even when solutions start to emerge, there are practical operational hurdles to actually implementing them, aren't there?
Yes, definitely.
I mean, bringing in innovative non-financial tools like these digital platforms we hear about, that costs money. There are implementation costs, subscription fees
Mhm.
maybe, and a financial institution needs to see a clear return on that investment, right?
Precisely. There has to be a business case. Plus, think about the process. Often you need to involve intermediaries like mortgage brokers or property managers.
Adding more complexity.
Exactly. That adds complexity to the data collection process, maybe requires changes to existing systems and workflows.
And what about privacy? I imagine that's a big one, especially with tenant data.
Huge. Privacy and consent-related issues are a major factor. Tenants, quite understandably, can be reluctant to share their detailed energy usage data with their landlord, let alone the landlord's bank.
Yeah, I wouldn't necessarily want my bank knowing my heating habits.
Right. So that complicates data collection significantly for real estate portfolios. Then there are the technical challenges just getting different systems to talk to each other.
Compatibility issues.
Yeah, compatibility challenges between these third-party data platforms or tools and the financial institution's own internal core banking or portfolio management systems. That can lead to data processing headaches, integration failures.
It sounds like a bit of a maze.
It can be. The overall user journey, as they say, for trying to integrate financial products, like a loan, with Financial ones, like an energy monitoring service, can get really complicated. You've got country-specific legislation, multiple stakeholders involved, technical integration difficulties. And it's worth noting, too, the European market, despite leading on regulation in some areas, actually has a relatively limited maturity in energy-related data collection infrastructure compared to some other regions, surprisingly.
Okay, so we've laid out the challenges pretty starkly, the data maze, the operational hurdles. Given all that, what's the most promising way forward?
Yeah.
How can financial institutions and real estate owners actually start making tangible progress on measuring and managing these financed emissions? Are there standardized approaches emerging that can help cut through some of this complexity?
Well, a really crucial foundation is the emergence of standardized methodologies. We mentioned PCAF earlier, the Partnership for Carbon Accounting Financials. PCAF provides harmonized, standardized guidance specifically for calculating financed emissions. It's designed to be aligned with the main GHG Protocol, and it's recommended by TCFD. So having that common framework is incredibly helpful in this complex landscape. It gives everyone a starting point, a common language.
Okay, so PCF provides that how-to guide for the calculation itself.
In essence, yes. But then, of course, you still need the data to feed into that calculation. And this is where leveraging non-financial products and services really comes into play.
Right, the tech side. Are these digital platforms and other services genuinely helping to fill those data gaps we talked about?
Yeah,
Making it easier to track actual energy performance in buildings, for instance?
they absolutely are. There are some really interesting digital platforms out there, companies like Elic, DeepKey, for example. They offer tools that can help track, analyze, and even optimize a building's energy performance.
How do they do that?
Well, they might integrate with smart meters, use building characteristic data, apply analytics. They can provide near real-time data on energy consumption and often give recommendations for energy efficiency improvements.
Okay, so they provide the data and potential solution.
Exactly. And alongside platforms, you also have energy service companies, or ESCOs.
NASCOs.
Yeah, ESCOs. Their whole business is energy efficiency. They provide services like detailed energy audits, they manage the implementation of efficiency, upgrades new insulation, better heating systems, solar panels, and they often offer ongoing monitoring and verification of the savings.
Ah, so they're like the implementation partners.
Exactly. They can support borrowers, the building owners, in actually doing the retrofits and then demonstrating the improved energy performance, which generates the data the lender needs.
This is where I imagine the real magic happens, right, when you connect these things. The financial products from the bank with these non-financial tools and services. Can you walk us through what that synergy looks like in practice? How does it help a bank reduce its financed emissions and maybe offer better products?
Yeah, that's a really powerful point, and it's absolutely key to making this work efficiently. So imagine a financial institution offering, say, a sustainability-linked bond or loan, an SLB.
Okay, where the interest rate changes based on meeting certain targets.
Exactly. The interest rate might be tied to specific KPIs, like reducing the building's measured carbon emissions intensity by a certain percentage over time.
Got it.
Now, the bank could bundle this SLB offer with perhaps a discounted membership to one of those digital energy monitoring platforms we mentioned.
Ah, okay.
So the platform helps the client, the building owner, actually track their energy use, identify savings opportunities, and meet those KPIs required by the loan.
Right, it empowers the borrower.
It empowers the borrower. And crucially, the data from that platform showing the improved performance feeds directly back to the financial institution. That gives them the verified data they need for their own Scope 3 financed emissions reporting.
That makes so much sense. It creates this kind of closed loop, doesn't it? Accountability, data flow, continuous improvement.
Precisely. It's a win-win. The client gets support to improve their building and potentially a better loan rate, and the bank gets the data it needs and sees a reduction in its financed emissions risk.
Okay, that's a great example. And how would partnering with ESCOs fit in?
Similarly, partnering with ESCOs can significantly de-risk property-linked finance for the bank. If a loan is contingent on certain energy efficiency upgrades being done, the ESCO can guarantee those measures are implemented correctly and monitor their performance.
So the bank has more confidence the targets will be met?
Exactly. It reduces the risk of the loan not meeting its green requirements. And again, the ESCOs provide the verified data back to the financial institution, supporting their financed emissions calculations and reporting. It helps ensure the green loan is genuinely green in practice.
Okay, this is all really practical stuff.
Mm-hmm.
It leads us perfectly into discussing something truly innovative that seems designed to tie all this together. the look-through advantage. Now, we mentioned Marcel Staub, the founder and CEO of Lookthrough, also involved with Novarka, focusing on scalable climate solutions. What is it about their approach, specifically this data-driven portfolio simulation, that makes it potentially such a game changer for these complex data challenges in real estate finance?
Right, look through. I think the real breakthrough with their approach is its potential to act almost like well, maybe a crystal ball for climate risk within real estate portfolios.
A crystal ball. Okay, tell me more.
Well, maybe not magic, but their core idea, this data-driven portfolio simulation, ESG, risks and opportunities, it's all about going granular, really granular. It's designed to allow institutions, banks, asset managers, property owners, to effectively look through the complexity of their entire real estate portfolio, to see beyond just the surface level.
And pinpoint what exactly?
Pinpoint precise risks and opportunities related to ESG factors, especially climate change, at the individual asset levels or across segments of the portfolio. This approach helps overcome those data limitations we discussed earlier.
How so?
By providing a structured way to analyze the data you do have, identify the critical gaps, and then crucially, simulate potential impacts. What happens if energy prices rise? What if regulations tighten? Which buildings are most vulnerable?
So it's about using data not just for reporting, but for forward-looking strategy, proactively identifying future problems or opportunities rather than just reacting to past performance.
Precisely. That's the key shift. This kind of data-driven insight enables financial institutions and real estate owners to make far more informed strategic decisions.
Moving beyond just compliance.
Yeah, moving way beyond just a reactive, compliance-focused stance towards a proactive, integrated ESG strategy. And look, that kind of proactive management, it offers a significant competitive advantage. It can help you allocate capital more effectively, manage risk better, and potentially attract new green funders who are looking for sophisticated partners.
And does this connect to that idea of stranding risk?
Absolutely. It connects directly to assessing a building's anticipated performance against what's called a stranding line or pathway. Think of something like CREM, the Carbon Risk Real Estate Monitor.
REM, okay.
Yeah, CREM provides science-based decarbonization pathways for real estate. Look-through simulation capabilities can help assess which buildings in a portfolio are on track to meet those pathways and which ones are at high risk of becoming stranded assets.
Meaning they become financially obsolete because they're too inefficient or carbon intensive.
Yeah, exactly. Assets that will need costly retrofitting down the line to remain viable or compliant. Identifying that risk early is critical. And this thinking also needs to incorporate embodied carbon, the emissions associated with construction materials and the building process, especially for new constructions.
Right, the whole life cycle.
Yeah.
Okay, so we've covered the problem, the pressures, the data challenges, and now some really promising solutions like standardized methods, tech platforms, ESCOs, and this look-through simulation approach. Wrapping this up, what's the core message you want financial institutions and real estate owners to really take away from our deep dive today? Is it just about bracing for the next wave of regulation, or is there something bigger at play here?
I think it's far more than just bracing for compliance, although that's certainly part of it. ESG reporting, especially on climate and financed emissions, is rapidly becoming a mandatory requirement in many places. That's just a fact.
So denial isn't an option.
No. So organizations must strategically decide their level of engagement. Are you just aiming to tick the minimum boxes required? Or are you going for full integration of ESG factors into your core business strategy, your risk management, your product development?
And it sounds like the future is demanding more detail.
Absolutely. The future of reporting is increasingly granular. For real estate, this means moving beyond those abstract ESG ratings or simple portfolio averages. It means getting down to specific data points like carbon intensity per square meter, the carbon in use, and, as we mentioned, embodied carbon for new builds.
And even metrics like that, years to stranding.
Exactly. Metrics like estimated years to stranding based on pathways like CREM, that's the level of insight lenders and investors are starting to expect.
So it really boils down to a commitment to continuous improvement then, not just filing a report once a year.
Precisely. Financial institutions are expected to continuously work on improving their data quality. That means engaging directly with customers and borrowers to try and source primary emissions data wherever possible.
Moving away from those broad estimates.
Moving away from proxies towards actual data. And critically, integrating climate risk, including financed emissions, into their core data systems and risk management processes. It needs to be treated just like they manage credit risk, market risk, any other significant financial risk.
And if we connect this to the bigger picture within these organizations, is there anything driving this internally?
Well, one powerful trend we're seeing is linking senior management compensation directly to achieving ESG metrics, including emissions reduction
Well,
targets.
hitting them in the wallet.
It's a strong incentive. It helps drive authentic organizational change towards decarbonization, ensuring sustainability goals aren't just siloed in a specific department, but are truly embedded right from the top down.
Okay, so a final thought for our listeners then. As you look at your own investments, maybe the pension fund you're in, or perhaps the properties you own or manage, how much thought have you really given to that invisible climate impact lurking within their financial footprint? How deeply will you choose to understand and maybe even influence that impact? Not just because regulations might force you to, but maybe to build a more resilient portfolio and, well, a more sustainable future.
Yeah, it's a question worth pondering. We really hope this deep dive encourages you, our listeners, to ask more questions about this, to dig deeper, and maybe look for opportunities to engage with this really rapidly evolving and, frankly, crucial landscape.